Investing inside your corporation, what Canadian business owners need to know. If you're a business owner or incorporated professional in Canada, one question you've likely asked is, should I invest my surplus funds inside my corporation or withdraw them and invest personally? In this video, we'll walk you through tax rules, the advantages and drawbacks, and what types of income are most efficient inside a corporation. Welcome to the channel. My name is Eric Selvaggi. I'm a wealth advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. Tax strategy for Canadian business owners. When a Canadian-controlled private corporation, often called a CCPC, earns income that isn't directly related to its core business activities, that is known as passive investment income. Types of passive income: interest, foreign dividends, rental income, royalties, capital gains, Canadian dividends. These sources are taxed differently from your business income, and that's where planning becomes important. How passive investment income is taxed. Unlike individuals, corporations don't have graduated tax rates. Instead, passive investment income is taxed at fixed rates depending on the type of income. Interest and foreign dividends are taxed at 50.67%. Capital gains are taxed at 50.67%. Only 50% of the gain is taxable. Canadian dividends are taxed at a rate of 38.33%. But here's the catch. Part of the tax is often refundable. That brings us to something called refundable dividend tax on hand, or RDTOH. RDTOH allows corporations to get some of the tax back when they pay a dividend to shareholders. Two account types: eligible refundable dividend tax on hand and non-eligible refundable dividend tax on hand. Eligible refundable dividend tax on hand are refunds on dividends from public companies or connected corporations. Non-eligible refundable dividend tax on hand are refunds from other passive investment income. When your corporation pays out a taxable dividend, it can recover a portion, about 38.33%, from the refundable dividend tax on hand account. It's an important integration tool that ensures corporate investment income isn't taxed more than personal income. The capital dividend account. Another important concept for business owners is the capital dividend account, or CDA. This account tracks tax-free income like the non-taxable portion of the capital gains and life insurance proceeds. What goes into the CDA? 50% of a capital gain, life insurance proceeds, and capital dividends received. What reduces the CDA? 50% of capital losses, capital dividends paid out. Outcome: tax-free dividends to shareholders when the CDA has a positive balance. The capital dividend account is like a special bank account inside your corporation. It tracks income that's not taxed, like half of your capital gains or life insurance payouts. When there's a positive balance, you can pay yourself or your shareholders tax-free dividends. But remember, capital losses and dividends already paid out reduce that balance. Comparing investment types, what's more efficient? Let's look at how different investment types perform inside a corporation after tax. Not all investment income is taxed the same inside a corporation. Interest and foreign income are taxed the most, leaving only $493 after tax. Canadian dividends are more efficient, leaving you with $617 after tax. Capital gains come out on top with $747 in after-tax value. Plus, capital gains added to your capital dividend account allows you to eventually pay out some of that gain tax-free. Small business deduction, a key risk. There's a risk many business owners aren't aware of: losing the small business deduction because of too much investment income. First $500,000 of active business income qualifies for a reduced federal tax rate, 9% instead of 15%. But if your passive investment income exceeds $50,000 in a year, the deduction begins to phase out. At $150,000, the deduction is fully eliminated. If your corporation earns passive income above the threshold, it could cost you tens of thousands of dollars in additional taxes on your business income. Integration, leveling the playing field. The goal of Canada's tax system is integration to ensure there's no long-term advantage between earning income personally versus corporately. In theory, if you earn $100,000 in a corporation and pay it out as a salary or dividends, your total taxes should be similar to earning it personally. But integration isn't perfect. Factors like provincial tax rates, income types, and refund accounts all play a role. Should you invest in a corporation or personally? Ultimately, whether you invest in a corporation depends on several factors. Your personal marginal tax rate, how soon you need the funds, type of income expected, provincial tax rates, whether the small business deduction will be impacted. If you don't need the funds immediately for personal use, leaving them in the corporation may provide tax deferral benefits, but it's not always the best long-term choice. The rules around investing in a corporation are complex, and the right strategy will vary from one business owner to another. Before you act, consult with your tax and wealth advisors to understand the implications for your unique situation. For personalized planning, speak to a qualified advisor. If you found this video helpful, consider subscribing for more guidance on tax-efficient business planning in a corporation. Thank you for watching.